Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. 17th of June, just after the close. What a week. I don't have to tell you what an ugly week this was if you're watching this video, because you are involved in the markets. We often say there was no place to hide, almost as a chuckle from time to time. Truly no place to hide this week. When the Fed raised rates 75 basis points, had an awful lot of trouble in the equity market, in the bond market, and the commodity markets, where there's been a little bit of an area that you could safely camp out. You saw energy down, finally, down under 110 a barrel on West Texas crude. Energy stocks in the last 5 or 6 trading sessions down almost 20%. They had been an outstanding performer and may still be. We don't know the answer to that. Like to see them get a little stickier, but we are obviously looking at those names on the pullback. I want to share a couple of charts with you because we saw extreme action in the stock market. And when I say extreme, I mean extremely rare action. The first chart I'm showing you is a overbought-oversold reading that we look at. It's a 10-week or 50-day moving average reading where we try to use it to be aware of possible reversion to the mean opportunities. Right now, we closed in the S&P over 100% oversold on a 10-week moving average. Think of it as a bell curve, and we are a couple, almost 3 standard deviations from neutral. This has only happened, 10 times in the last 20 years. So I think this is important to be aware of. Doesn't mean you become a full-fledged buyer immediately, but you do want to understand that from an oversold number that we're currently at, historically, trading opportunities have come up to the upside. Now, often they were only trading opportunities, but they could be steep. Look all the way to the left. Everybody remembers 9/11. Market was closed for 4 days, reopened on 9/17. The week that it was open, the S&P hit 140% negative number in oversold territory. A little bit of a trade off of that. Following year, in the meltdown of technology, worse than we're seeing now, but some echoes of it, another difficult period. If you were a nibbler in there, you ended up doing very well over the next 4, 8, and 12 weeks. Take a look at the jump all the way out to 2008, where we see 1010, 1017, 1024. Look at those numbers. S&P oversold to the tune of 152% on 10/10/2008. Who remembers that? Well, the banks were just about out of business. Fed had to come in, save the banks and the insurance companies. For a period of 3 weeks there, didn't know if the markets would even operate properly. Post that meltdown, there was a buying opportunity. It didn't last, but there was a buying opportunity. Market rallied post those numbers. We go all the way through to 18, when we had some of the headaches with China going on, as well as the Fed talking about raising interest rates. Now we get to 20, COVID. Look at that number. Now we're already back to 100% oversold for only the 10th time in the last 20 years. Very rare. Very rare. We want to be aware of that. In terms of a second chart, Charlie Bolello puts out some great work on charts and graphs, and he put one out on his Twitter yesterday talking about another rare occurrence. The number of stocks trading above their 50-day moving average in the S&P dropped to 2%. Very, very rare. Look it back from right to left. You can see it almost coincides with that oversold reading we just discussed. But what's interesting is Charlie put in a going forward return graph. And there are some positives there. You can see when we get that kind of extreme reading, going out 1 month, 3 months, 6 months, 9 months, good things started to happen. I will point out that going hand in hand with many of these extremes was a Fed that was becoming more accommodating. We don't have that right now. So important to realize that markets are like snowflakes. From a distance, they all look the same. But when you look at them up close, very different. We're in a different market today. But when we sit in the trading room, we do have to be aware that we're trading at extremes that have prompted rallies in the past. So we'll be looking for those kind of names. We'll be looking for that kind of action. In terms of trading this week, well, the trading gods had to be paid. What do I mean by that? That's an old Wall Street expression. When you're out of line in your portfolio, when you're positioned poorly, you don't get to get through a bear market without paying the trading gods. So you have to kick a couple things out that you don't even want to. We had to do that in a couple spaces. Small this week. To give you an idea, in tactical, we're about 30% cash. In U.S. core, we're about 17%, 18% cash. In U.S. ETF, we are approximately 13, 14% cash. In international, we're about 10% cash. Nothing's working beside cash, so we're paying the price for any kind of long lean. We'll keep adjusting. We'll stay flexible. You'll see some trading to both sides in the accounts. So it's an interesting period. Who makes money in these periods? People that keep their heads and stay flexible. We've talked about this often, about the light switch. Very difficult to trade markets by jumping in and out. We try to dim the light, then turn it brighter. Dim the light, turn it brighter. That's the way we try to work through these markets. And for clients that have been with us and with myself through all the periods we just discussed, you know we've gotten through those periods in very good shape by keeping our head. So that's our goal. That's what we'll be talking about in the trading room, day to day, week to week. The Moose is going through some of the same things in fixed income. We had a rip higher on the Fed number. I think the 10-year at one point was trading at 350 before it backed well off that. So why don't we go over to John? I'm going to toss it to the Moose, who's taping remotely this week.
Hi, it's John Mousseau. I am the CEO and Director of Fixed Income at Cumberland Advisors. It is Friday afternoon on June 17th. Tough week on bonds. You wouldn't know it if you just looked at the change from last week. 2-year bond at a 314, 5-year bond at a 332, the 10-year at a 320, and the 30-year bond at a 327. They're all up 5 or 7, 8 basis points from they were last Friday. At different points this week, they're as high as 30 basis points higher than they are right now. Lots of volatility in the market. What drove it? Easy. You saw the Fed funds rate target get boosted this week from where it was at 0.75% to 1%, now at 1.5 to 175. 75 basis points by the Fed. That is a big move. And when you think about it in the context of what the Fed has done in the past, which has been much more incremental, 25 basis point moves, things along that nature, it was a big move on top of the 50 basis point move and the first 25 basis point move that we saw in March. Markets are spooked about this. Markets are spooked because if you looked at the inflation number, so we're still at a hangover from last week's CPI number, which came in at 1% when they were expecting 0.7. PPI came in this week, I can't say well behaved, at 0.5 when they were expecting 0.6, but they're in that level. It's still elevated when you multiply it by 12. I think the problem the markets are having is that after a few weeks with the perception that inflation was starting to slow down, these numbers spook the market, and they know they are spooking the Fed to act more aggressively. We have a chart here showing the Fed funds target rate, upper level, going back 30 years. And one of the things that's different is the fact that downward movements in Fed funds of this amount, 50 basis points, 75 basis points, fairly common when you see the Fed, because over the last 30 years, the Fed has cut rates a lot. And we've seen it in different time periods. When did we see it? We saw it, of course, during the Great Recession back in 08, 09, aggressive cutting of short-term rates. We saw it again during COVID, a slashing of rates. What you don't see, and you really have to go back to 1994 to see this in this chart, is a sharp uptick in Fed funds rate in one move. And that is different, and it's different from the way the Fed has acted. So it is clearly spooking the bond markets. It did settle down at the end of the week. Munis really hurt this week. Unfortunately, they're probably up 30 basis points across the curve this week. And the main reason is that bond investors got spooked again, and you saw aggressive selling of bond funds, outflows in the neighborhood of $5 billion. That was disappointing since only a couple weeks ago you had inflows. We think the muni market is very cheap. I think more importantly is when you start to look at where bond yields have come from. So you're talking about a 10-year bond at a 320 range. Remember, start of the year at 150, so that's a big movement. At the same time, you're starting to see numbers that would suggest a little bit of a slowdown. The Philly Business Index went negative this week. Very unusual to see that. That would suggest that things are slowing down. You saw certainly things like housing starts slide. They were expecting down a little bit, 1.5, 1.8. They were down over 14% month over month. Big change. Same thing, retail sales, negative, minus 0.3. They're expecting a positive 0.1. So at the same time that we see the market's very concerned about inflation and yields rising, we're seeing some movements that we think are suggesting that the economy will be slowing down as we head later into the year. We hope everyone has a nice long weekend and a happy Father's Day to all the fathers out there. Thanks a lot.
Thanks, John. Tough week, but I know you're ready to get right back at them next week like myself. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. Have a great weekend. We'll see you next week.